Hello everyone. Today is Sunday, the 26th of July, 2026, and this is episode number 87 of JustDario, Cigar Time. Today, I will discuss the oil market again because in the current circumstances, it is impossible not to do so. But I will also spend time on AI and semiconductor stocks in the second part of today's podcast because we have reached a critical juncture in the AI bubble story. And it is important to address what is happening by looking at objective data and what is developing beyond the noise and biases. In order to understand what is likely to happen in the following months and perhaps here, as this AI bubble will deflate gradually. Before we begin, if you like my content and want to support my work, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates. As I record this update, the Houthis and Saudi Arabia are exchanging fire in a significant escalation. It has been reported that a third Saudi-related oil tanker has been hit by the Houthis in the Strait of Hormuz on Friday. The Houthis also successfully struck important oil refineries in the district of Jazan, which account for roughly 400,000 barrels daily, and claimed attacks on Aramco infrastructure in the city of Yanbu as well. None of this has been officially confirmed by Saudi Arabian authorities, but compelling evidence has been circulating on social media that proves it. I expected this development, and remember, I posted about it on X as well and in advance on Friday, when I reminded everyone that the Houthis threatened not only to shut the Bab al-Mandab Strait to any Saudi-related ship, but also to hit ports and oil infrastructure, raising pressure on Saudi Arabia to lift the embargo imposed on them for many years. The market still has not properly considered Houthis-related developments in its full extent this week. Many commentators said Saudi Arabia could reroute its oil trading shipping through Suez Canal or use an Egyptian pipeline in the Red Sea. However, these people failed to highlight two important things because it is convenient to support their hopeless narrative. Rerouting through Suez Canal will increase shipping time to Asian customers who buys most of the oil from the Middle East by 39 days due to circumnavigating Africa. Also, Suez is a canal and cannot accommodate the whole flow that previously crossed the Bab el-Mandab Strait. The flow of oil supply from Saudi Arabia routed through the Suez Canal will decrease from 4 million barrels a day to about 1.5 million barrels as a consequence. This will not only impact the oil supply all over the world, but also lead to shutting production in Saudi Arabia. This will happen once oil tanks in the eastern part of the country become full and cannot accommodate the current production. Furthermore, the recent developments over the weekend highlight the great danger of a successful Houthi attack on big export hubs, endangering that storage capacity. These attacks can potentially wipe out prompt available supply, especially at the port of Yanbu. That is also where the strategic east-west pipeline ends, and they will surely attack that pipeline eventually. An attack on that pipeline could bring total supply out of the Middle East to virtually zero. From a fundamental perspective, all these developments are increasing the pressure on crude oil prices to rise. However, market manipulation will not give up easily, and it was incredibly obvious during trading on Friday. After a powerful short squeeze developed on Thursday, it ended during US hours when a shift in sentiment, when headlines started floating the possibility of a massive attack on Iran by the US that could quickly end the war or a reopening of peace negotiation. The sentimental narrative shifted because people were short, hoping Trump would pull off a tackle and cool down crude oil prices. And as you can see in the chart, heavy price manipulation then started on the following day on Friday at 1:30 a.m. Eastern Time during very illiquid overnight trading hours. This manipulation reached its apex when the price was driven down from $93 to $87.5 heading into the weekend. A reckless move because an escalation from the military front would surely have come over the weekend. But trader positioning and the unwinding of excessive short significantly influenced the last hours of the trading day on Friday. And as you can observe, WTI crude oil managed to regain the $90 level while volatility started to rise sharply and closed above 80. This is a clear sign that significant buying or edging occurred in the last part of the trading day of Friday due to the potential escalation risks over the weekend. The direction in crude oil future is obvious, but as I wrote last week, we are in a state control stage of prices. Government-sponsored price manipulation will not allow oil prices to trade at their natural equilibrium, which should already be way above $120 a barrel anytime soon. These shenanigans suppress the market and do not provide real price discovery, indirectly damaging the real economy, whilst oil shortages cannot be hidden anymore in the near future. This distortion is visible in the price of diesel, which rose sharply and closed above $4.2 a gallon in Europe. Before moving to the second part of today's podcast, if you are interested in my premium analysis and commentaries, check out my Slice Finance portal, where not only I constantly post premium content, but where you can also directly interact with me in the growing community chats and during the weekly live streams. I will host the next live stream on Slice next Monday at 10 a.m. Central European Time. If you're interested, you can find the link to subscribe to my Slice portal in the description of this video. Now, I want to spend some time on AI, hyperscaler stocks, and semiconductors because there were significant developments this week on this front too. Google and Intel reported Q2 earnings, and despite their management continuing to push a bullish narrative, traders reacted badly and sent both stocks sharply lower. Alphabet, the parent company of Google, closed Thursday down almost 7% after Q2 earnings. Intel had an incredible move, jumping 8% first in after-hour trading on Thursday, only to close the trading day on Friday at minus 8%. This truly underscored the sentiment shift in the market with regards to AI. Google now has a negative free cash flow for the first time in its history without providing a meaningful return on investment on all its huge amount of capex investments into AI. Investors are concerned because they always valued these companies as asset-light software cash cows. But these companies use their cash flow to finance their AI infrastructure build-out to the point that it has been depleted. And they are now forced to raise debt and even equities to support their capex spending. This marks a significant change in the whole structure of hyperscalers' stocks valuation. Share buybacks, which pushed prices higher for many years, will also inevitably slow down and potentially stop due to lack of supporting cash flow. When you use this type of financial engineering heavily, you can expect significant downward pressure from the lack of buying that came from share buybacks. In the case of Alphabet, we can expect a similar share price behavior to what we experienced with Oracle in the next future. Oracle was one of the first large companies disclosing negative free cash flow, and as a result, its shares dropped significantly from that moment with only short-lived rebounds. Shares of Oracle lost more than 50% of their value since the beginning of June, and almost 70% since its all-time high in September last year. It is also important to notice how Intel, despite reporting stellar results, was punished by traders because management flagged the risk of needing to raise debt to finance future capex spending. Investors are growing skeptical about very large capex spending that is failing to yield positive ROI for many years now, especially after Chinese open source model achieved top performance aligned with US frontier models and a fraction of a cost. Frontier AI models are 10 times more expensive to access, train and operate compared to Chinese counterparts. And understandably, investors are growing worried that the massive amount of revenues they promised to justify over $1 trillion of capex overall will not materialize. Personally, I expect similar developments in the upcoming earnings of Amazon, Meta, and others, with investors punishing the stocks if they don't show convincing progress. I would not be surprised if the weakest hyperscaler of the pack, which is Meta, will be the first to announce a reduction in capex in the future. But I don't expect to happen this quarter, since the marching orders are to keep the AI charade going as long as possible. This would be similar to when Facebook invested heavily in the metaverse. Investors started to punishing the company, that in the meantime also changed its name to Meta, let's not forget, and the stock only recovered after the waste of capital to build the metaverse ended. This coming week, a potential danger for the AI bubble will be the earnings of SK Hynix, whose stock has already lost 42% of its value in the past month. This is due to the shifting sentiment in the Korean market, where regulators are also curbing excessive speculation. If SK Hynix earnings are less than stellar, a strong bid might not even be enough to satisfy investors. And if management fails to convince investors that revenues will remain strong in the future, the risk of a sharp drawdown in SK Hynix and other memory names could cascade into other semiconductor and AI stocks. This can potentially accelerate the downward spiral path upon which the AI bubble seems set. Thanks for listening to the podcast today, for subscribing to my slides portal, for supporting me on X, and for reading my research on JustDario.com. I wish everyone a nice Sunday and a good week ahead. Bye.